With the growth of 24/7 trading, with the growth of tokenization, the growth of prediction markets, the importance of the velocity of money has only started to increase even more. And that's where stable coins are unparalleled.
The gap between how fast information moves and how slowly money does has always created friction.
As consumers demand greater access to digital assets, crypto has shifted from a fringe technology to increasingly mainstream infrastructure. This week, on Fintech Files from BCG Platinion, we're joined by Edward Woodford, founder and CEO of zerohash, to explore what it takes to integrate crypto into traditional financial infrastructure, and how stablecoins are emerging as a real-time payment and funding layer of the world's largest financial platforms.
When Edward founded zerohash in 2017, the infrastructure to bring digital assets into traditional financial platforms barely existed.
Regulatory frameworks were sparse, custody was unsolved, and the path to market for any company trying to build in the space was long, complex, and largely undefined.
The original vision was to be a provider, B2B2C infrastructure provider to the largest companies and startups. We've always viewed this as a technology. And so that now manifests itself in, for example, crypto trading, stablecoin transactions, cross-border, as well as tokenization infrastructure. And the commonality of all of this is the underlying cryptographic blockchain. And so for us, it's the same engine that powers, for example, a piece of Ethereum to be traded, a piece of USDC on Ethereum, or a tokenized deposit on Ethereum. And so that commonality, that technology has allowed us to expand the business over time into new areas. But the commonality, the core engine has always remained the same, which is moving things on-chain, high velocity with trust. And I would say that our thesis has evolved increasingly now as we work with GSIBs such as Morgan Stanley and others, which is how can you allow big established companies to innovate without there being a trade-off, a zero-sum approach towards trust? So our goal is to allow companies to innovate in a really trusted way without any trade-off.
You mentioned Morgan Stanley and also Interactive Brokers. Can you explain in very basic terms what exactly it is that you then provide to them?
So for both Morgan Stanley and Interactive Brokers, we provide the full stack solution to allow them to offer crypto to their end customers. And so, for example, with Interactive Brokers, we offer this globally, including in Europe, as well as the US. And we provide them the ability to offer this and to own the client experience without the technical complexity of liquidity, custody, settlement, and all of the nuances around offering a crypto product. So effectively Coinbase out of the box. And we see an increasing convergence between traditional financial services companies and crypto companies competing for the same customer. I think at the end of the day, customers want a diversified portfolio. And so in the same way that Coinbase is offering stocks, groups like Interactive Brokers and Morgan Stanley have offered crypto. That relationship has expanded with Interactive Brokers to enable stablecoin account funding. So this is enabling customers to fund their brokerage accounts, and that brokerage account can be used to buy crypto, it can be used to buy stocks, it can be used to buy commodities. So it's agnostic. It's an account funding product where the stablecoin is converted instantly into dollars. And the value proposition to Interactive Brokers and its customers is it allows customers to fund anytime from anywhere, 24/7, 365. And so there's this convergence that's occurring, and we power that conversion to allow groups to embed crypto within their stack, own the entire UX, but without the technical and regulatory complexities. So zerohash provides the liquidity, we provide the custody, we provide the whole building block to allow partners to quickly scale globally without the need to build out a complex technical stack. And there's a lot of drivers why that's important and why the velocity of money really matters. So you can say that the drive of tokenization, the drive of 24/7 markets, the drive of prediction markets, all increasing the importance of velocity of money. And that's effectively what stablecoins can provide. What I think is also really interesting is the global nature of stablecoins. So when you look at, for example, Interactive Brokers, they have a global client base, they built out a global brand, and information is global, but value transfer has frictions. And so stablecoins allow customers from everywhere in the world to fund quickly and easily and seamlessly. And so what we've seen and what we've publicly disclosed is partners have enabled funding from over 80 countries from this month in stablecoins, which is an enormous number. So you're activating customers, which is really, really exciting.
It's funny that you mentioned this. Once I moved out of Germany to the Middle East, first to Dubai and then to Riyadh, we switched to Interactive Broker because of the international availability. And until this conversation, I was not aware that the crypto offering is basically backed by zerohash. Super cool to know.
The crypto and the stablecoin account funding. Yes, exactly.
Looking maybe from a process perspective. So when a major bank or brokerage decides they want to offer crypto or stablecoin products, what does then the decision-making process actually look like? And where does zerohash here come in exactly?
Some of the key things that people look at, right, is a traditional decision, which is, do we partner, do we buy, or do we build? And I think there's a ton of reasons why partners partner with zerohash and more generally use an infrastructure provider. The first is speed to market. The second is just there's a lot of unknown unknowns with crypto. There's a lot of nuance and complexity. And the ability to attract talent and to build this, one is very, very complex with a very long time horizon. And how do you do that quickly? We partner with a number of different players across the board, whether it be tastytrade, Public, Franklin Templeton, Stripe, Interactive Brokers, Morgan Stanley. And they've all made the decision that we want to work with we want to offer the best-in-class product. We want to focus on the UX. We want to focus on the embedded experience as opposed to the back office infrastructure. And so we offer a very attractive revenue share model. Our partners keep the majority of the revenue that's generated. And so effectively, for partners, it's a no-brainer, I think, where you keep the majority of the economics with no fixed costs and with a best-in-class product that evolves very quickly. And as I mentioned earlier, this is a living and breathing space. So look, if you start to build now, what you're building now will not be sufficient and will not be best in class in 2 years' time. So the need to continuously evolve your technical stack is critical. And what I mean by that is, look, Base didn't exist 3 years ago. Base is now a major blockchain for stablecoin movement. Canton has become a major blockchain in a very short period of time, being able to support that. So our goal is to innovate and continue to evolve the stack to allow partners to be on the cutting edge of innovation and choice, whilst also keeping the majority of the economics.
The technology stack underpinning all of this is constantly shifting. New blockchains emerge, others gain scale. And what's best in class today may not be so in 2 years. And nowhere is that complexity more visible than with stablecoins.
Stablecoins can sound deceptively simple. Just a digital coin you attach to a dollar and then you move around instantly.
But once you scale that across institutions, currencies, and blockchains, the picture changes quickly.
Sometimes I say this to be a little flippant, but to actually make the point. Stablecoins have evolved as a major alternative payment method, a money movement method, despite being largely unusable. And what I mean by that is if I were to send you a stablecoin today, the number of questions I'd have to ask you is pretty high, and the UX friction is pretty high. So if I said to you, Annika, I owe you coffee, I'm going to send you USDC. Well, you say, well, look, I have a USDT wallet. Okay, well, we have that issue. So we live in a multi-asset world. We also live in a multi-chain world where, for example, USDC is on 32 different blockchains. So multi-chain drives a lot of fragmentation. And that fragmentation creates complexity around both the technical aspects, so the importance of buying the native token to be able to send an asset on chain. When I send you USDC on ETH, I've got to pay a fraction of ETH to fund that. So there's the technical complexity. Secondly is interoperability, both cross-chain and cross-asset. How do you make it easy to send an asset where there's a lot of fragmentation on that chain? And then finally is usability. Look, sending you a coffee, I may not worry about, but if I'm sending you $1 million, it's kind of scary to copy an address. So usability is a huge thing that we focused on as well. So those are, I think, three of the key complexities that we abstract away, which is interoperability, technical complexity, as well as usability. And these things are at scale complex to do. Blockchains are living and breathing things. They evolve and they change. And the importance of, for example, accelerating transactions on chain to ensure that they get there quickly, to monitor these different blockchains, to maintain the nodes is complex at scale. So there's a lot of complexity. Obviously, our goal is to abstract away those complexities to make it as simple as an account-to-account transfer. Edward is funding his Interactive Brokers account. Annika is funding her Interactive Brokers account from Saudi in her account. And it's an account-to-account transfer, abstracting the complexity of both chains and assets. And that's really what we do. But to do that at scale and to do it well is very, very complex.
I can imagine. Where are you seeing the most exciting real-world traction with stablecoins right now?
What really excites me is two-sided marketplaces, so payouts of stablecoins. And what's really adjusted over the last few years is the accessibility of stablecoins through people's primary accounts. So if you're in Brazil, you can have a new bank account. If you're in Europe, you can have a Revolut account. In the US, you have a Venmo, PayPal, or Cash App account. These are now all stablecoin enabled, as we would call them. And we predict in our 2026 Momentum report that we released earlier this year, there's about 1.8 billion accounts that are stablecoin enabled. And so what that means is you can accept stablecoins instantly into an account that you already have, and then you can then spend that balance, or you can convert it into local currency or just hold it. And so here we have clients like Gusto, which is a two-sided marketplace where people are providing their services to their company. And the freelancer or the contractor or the employee wants to be paid out in stablecoins. And why do people want that? Well, one is if they live in a country where the currency is volatile, they may want to hold stablecoins. But secondly, is just velocity of money movement is really important for a lot of people in the world, meaning that if you're paid on time and quickly, that's really important. So just shifting the paradigm of what is labor. The way that labor works is I provide labor to my company and I'm effectively providing credit to my company. That's the way I think about labor, because I don't get paid for 2 weeks. Now, I'm fortunate. I don't worry about not getting paid every 2 weeks. I actually don't even worry if I got paid late, but I'm in a really fortunate position. 70% of Americans can't deal with a $1,000 shock to their system. A lot of people in the world take payday loans for work that they've already done. So if you can make payroll and what is owed in a two-sided marketplace, whether that be a Fiverr, an Upwork, an eBay, that velocity of money solves a lot of friction for a lot of people, where there's high costs of moving money globally and there's latency in getting that money. So payouts for me is incredibly exciting into local accounts, and groups like Gusto that we power is incredibly exciting. And I think it is value accretive for the world.
Stablecoins aren't the only model emerging. Tokenized deposits are gaining ground too. And with the Genius Act, the US's first federal framework for stablecoins, now defining the rules of the road. The distinction between the two is becoming increasingly important for banks.
Yeah, so at least in the US and in Europe, stablecoins is a defined term. So in the US, the Genius Act, which is still being implemented from a rulemaking perspective, defines stablecoins where a dollar is issued by a trust, a state chartered trust or a nationally chartered trust, where 70% of those assets roughly are backed by short-term government debt. The difference with tokenized deposits is that it's a bank deposit under a fractional reserve banking system that is tokenized. So it's really what is backing the stable instrument as opposed to the underlying technology. Now, there's reasons why both exist, but that's the core difference. It's a legal, practical difference of what is backstopping those assets. My strong opinion is that banks will issue tokenized deposits for the core reason that they will get a better rate of return on that deposit with fractional reserve banking than holding 70% of those assets in short-term treasuries. That is a reality. The underpinning is that you are taking something that can be moved on a blockchain 24/7, 365, reducing costs, reducing intermediaries, and increasing velocity and global accessibility. That is the commonality between them. But what backs them is what differs. Now, I think stable deposits are growing. You've seen JPM and other banks announce these things. And again, I think some of the same frictions that exist in stablecoins are the same that exist in tokenized deposits. And these are the things that zerohash are solving for, which is a very real question. If I have an account at JPM and they tokenize a deposit, and you, Annika, have an account at Citi and they have a tokenized deposit, how do I send you money, right? Citi's not going to accept JPM, tokenized deposit. And so I think that interoperability is a key question that is being solved for, and that has been solved in stablecoins and is increasingly being solved in tokenized deposits.
You already mentioned the example of banks. If I'm now a bank or another institution that wants to work with you, how can you then help to think through whether to build, buy, or partner on the digital asset infrastructure?
Yeah, I think the first question is, what do you want to achieve? What is your objective? And I think often the objective is we want to move in a way that is trusted and a way that we can move expeditiously at this point. And if those are your objectives, and I think finally, where do you see the value accretion? Where do you see value accruing? So, lots of banks have built trading products, but they still use the DTCC. They still use trading infrastructure. And so I think the core question is, what are you trying to achieve? How quickly? And where do you see value accruing? Also, the one big thing that I always stress to banks is what decisions are one-way decisions. I.e., once you step through that door, can you ever make a different change? And that's something that we talk a lot with banks, which is, hey, our system is incredibly modular. If one day you want to be the custodian of the customer assets, that's fine with us. And here's how you do it. So I think the final thing that banks and FIs need to think through is, look, if those are what we're optimizing for, also, what are the decisions where we can't adjust our strategy in maybe a year's time, 2 years' time, 5 years' time? And I think that's kind of the framework that I talk to banks about.
The line between crypto platforms and traditional brokerages is blurring. Coinbase is offering stocks. Robinhood is moving into wealth management. BCG's research projects that stablecoins alone will reach $3 trillion in market capitalization by 2030. The pressure on traditional wealth platforms is real, and it's coming from both directions.
I think there's this massive convergence that's clearly existing. And one of the things that has got partners to move is just they've seen the outflows of customer funds into crypto accounts. And those crypto accounts are now no longer just crypto accounts. They are directly competing for that business on equities and on commodities. And I gave the example of NinjaTrader being bought by Kraken and, Coinbase building out a broker-dealer and offering stocks. So my strong opinion is in the next 5 years, when you look at Coinbase's financials, Robinhood's financials, and say another brokerage firm, they will look increasingly similar if you look at the line item of where revenue is generated from. And particularly when you think of the global wealth transfer that is starting to occur, in particular where older generations are passing wealth down, younger generations want more diversity, more flexibility, more innovative asset classes. And, we've done a survey that was independently commissioned, that was picked up by Forbes, where it showed that younger demographics, people below the age of 40, 66% of them would consider moving their wealth manager if they didn't have crypto. And so the number one driver of what triggers the transfer of wealth is death, effectively passing through assets. And so if the younger generation wants crypto as part of their portfolio, they already hold crypto. They want a single view of their wealth. Wealth managers are looking at that and saying, look, we need to offer this. And Morgan Stanley is one of several partners that we've announced or will be announcing that are traditional wealth managers that have seen the need, seen the demand, seen the data, and have started to offer crypto as part of their stack.
This is all possible because the regulatory environment has shifted significantly over the last years. Can you maybe elaborate a bit how that has changed what's possible for zerohash and also the institutions you work with?
Yeah, look, so we've been building since 2017 and we've seen different environments and we've scaled the business in those different environments. What I say has occurred over the last few years is kind of threefold. And I think it's nuanced and I think it's important to go over. So there was regulation by enforcement, which people understand, where regulators would go after people who are asking for clarity and they were effectively saying, we're not going to give you the clarity, we're going to sue you. That's the first thing. Then there was regulation by implication, where certain agencies tried to dissuade large FIs from entering the space through letters. And then finally, there was regulation by rulemaking. So, for example, in the US, there was a policy called SAB 121, or an accounting bulletin put out by the SEC that made it very, very complex for public companies to offer crypto. So those are regulation by rulemaking, regulation by implication, regulation by enforcement. Those things have been pulled back. Now, there has been new laws that have been passed and implemented. In Europe, there's obviously the rollout of MiCA. In the US, there's obviously the rollout of Genius. And these are incredibly powerful and helpful to provide clarity and structure and confidence in making those decisions. But I would really stress that policy has been one element. The other pieces is the pullback of those non-policy, non-legislative approaches that were taken. And we've seen that pullback. For example, it's a niche, but it really mattered. SAB 121 was overturned with the implementation of SAB 122, which really makes a big difference. And some of your listeners will be accounting geeks. It really, really matters. These softer, almost below the surface elements really have mattered and have shifted the conversation and the story.
Sounds really interesting. When we now look into the future, so what needs to happen next in terms of infrastructure, standards, and also the industry behavior, what needs to then happen for this to basically reach the next level of scale?
Yeah, look, I think blockchains are networks and networks are two-sided. And I think there's two elements. So one is the accessibility of this technology has grown. As I mentioned, stablecoin-enabled accounts, we project them to be about 1.8 billion stablecoin-enabled accounts. And that makes it easy for customers to interface with this technology. So somebody in the Philippines, they have a Gcash account and they can accept stablecoins seamlessly and easily without opening up a new account that automatically becomes spendable in those accounts. That is really important. So the distribution of technology is massively important. In the same way that the distribution of the iPhone allowed for the App Store to be built and for applications to be built. So I view wallets almost like the iPhone. It creates a distribution, and then you can create the technology layer and use cases on top. The second big thing is interoperability, which I've mentioned a few times just because it is so critical to the conversation. You look at any technology, you look at SMS, for example. When SMS started, you could only send SMSs to people that were on your same network, right? If you were on Verizon, you could only send messages to somebody on Verizon. When it became possible to send from Verizon to AT&T, that is when the number of messages exploded. We're in the same construct in stablecoins, where as the interoperability infrastructure continues to develop, led by zerohash, that allows for the use cases to explode. And the abstraction of complexity, the abstraction of these kind of silos is massively important. So to answer your question directly, it's continued growth of the network effects coupled with interoperability.
Where do you then have your sights set for zerohash over the next few years? And what should maybe also our listeners be paying attention to in this space that they are not yet paying attention to?
Look, every company becomes a stablecoin-enabled company. I truly believe this. You're starting to see this in the gig economy. If you think of groups like Uber, DoorDash, Instacart, if you think of creator platforms, X, Instagram, TikTok, YouTube just enabled PYUSD payments, for example. Two-sided marketplaces, Amazon, Etsy, Upwork, Fiverr. If you think of payroll platforms, Gusto, Remote.com, both of which are clients of zerohash. So I think payment and the velocity of money becomes a real differentiating factor in a world of value transfer. I also think if you look at AI, stablecoins can play a very, very meaningful role. And so what I mean by that is if you believe in an agentic commerce world, I think the importance of data transfer is going to explode. You're going to have millions of distributed agents communicating with other millions, if not billions of other agents. And for example, somebody listens to this podcast. I think the world will evolve much more similar to like Spotify, where you pay Spotify based on the minutes that you stream. I think LLMs over time won't be able to just scrape and take information for free. There'll be effectively a market for data. And so if there's a market for data, how do you have a decentralized billions of permutations, billions of connective tissue without a centralized entity? So I think that's where smart contracts and stablecoins can come in, where you have tokenized data. So New York Times gives an LLM a piece of data, and a smart contract basically allows for the transfer of data for the transfer of the stablecoin. And that to me is where stablecoins come in. They're global, they're distributed, and they're programmable. That is exactly what you need in an agentic to agentic communication framework.
Awesome. So in the future, we can then also see stablecoin-backed AI agents communicating with each other.
I think it's a critical unlock. Yeah, I really do believe that.
This has been Fintech Files from BCG Platinion.
This season, we're digging deep into the ideas reshaping the future of fintech. Make sure you're subscribed so you never miss an episode.
Thank you so much for tuning in. We'll see you next time on Fintech Files.